going to talk about withholding tax on services across Africa. Now, in my experience, most tax advisors who haven't dealt with Africa or developing countries ignore withholding taxes because generally they only apply on dividends, interest, and royalties, and generally they're at a fairly low rate because they're reduced by a relevant double taxation agreement. Now, in Africa, we do have high withholding taxes on dividends, interest, and royalties. They're generally not reduced to very low rates under double taxation agreements. But even worse, we often have a withholding tax on services. And that is often not expected by the non-African focusing multinational, and it can have a very significant impact on the project economics. So can you talk us through how Africa generally approaches withholding tax on services and why this is such a big deal?
I'll endeavour to, Gideon. I think, firstly, yes, African countries generally seem addicted to withholding taxes and a much broader range of transactions than perhaps we're familiar with in the more in the European or North American world. And why? Because it's a way of raising money and it's a way of making sure you get some tax even out of the people who are recalcitrant when it comes to registering and paying. So it's seen as both an enforcement tool and as an easy, relatively easy and cheap way of collecting the money. So it is very common, high rates of tax, and broadly, if it moves, they'll tax it. So service, yeah, very often, and quite surprisingly often, even goods. And yes, it can cause problems. Have you got the right rate? Have you paid the right tax authority? If you paid at the right time.
And what I've seen, Russell, we did talk when we spoke about mining that often taxation on mining is driven from an emotive viewpoint where foreign companies who mine in Africa are deemed to be baddies. It seems to me similar in terms of withholding tax on services. So the kind of underlying view seems to be that if an African country is paying a foreigner for services, it's bad and they should maximize the withholding tax levy on it. Is there some truth to that?
I think there is. I don't think it's always the entire reason, and that's why we see domestic withholding taxes as well. But there's a great point of it, and that if I don't tax it, then somebody's taking money out of my economy and not paying tax. And secondly, they should buy local, and then at least would trap the revenue in the country. And a final one, I think somebody's got to pay tax to run the country, and foreigners can be quite appealing because they don't vote, and there's not an awful lot of sympathy for them. So I think those are the kind of reasons why they become very common and quite high rates.
Makes sense. And can you talk about double taxation agreements? So do double taxation agreements reduce the services withholding tax? And are there any problems we need to be aware of?
Well, they can do. One first thing is there a DTA that applies. Secondly, if it does it reduce the rate? Have you properly classified the thing that's being paid for in terms of both the domestic law and the treaty? And there's some strange things, some lacunae where you suddenly find there's nothing in the DTA, or argue me not, and then they'll try and argue the tax authority that is will try to argue it should fit in the other income clause, which is not normally very nice. So those are parts of it. But even if the reduction applies, does the treaty automatically apply? And increasingly commonly, you have to apply for it. Somebody has to apply for it. It may well be your customer who's going to be deducting the tax who has to apply or has to be convinced that he should be using the lower rate. Otherwise, he's going to think, well, I'm giving the supplier a benefit here, and I'm taking a risk that the tax authority will come and hammer me. So at the very least, he may want a ruling, or secondly, he may say, you've got to go and apply to the tax authority, show that you're resident in the treaty partner, and that haven't got a permanent establishment in my country, and that you're entitled to the lower rate. Once you produce this piece of paper, then I'll give you the benefit. Getting that piece of paper can be a paper chase because you're probably
Yeah.
going to go to your home country for a proof of residence and then take it back to the country you're working in, and it'll take a wee while. But again, better done earlier, because if you leave it till later, you may find you lose the withholding tax. And there's generally a bit of a one-way valve, I think, on withholding tax payments. You can pay quite easily, but getting it back is quite hard.
Yeah. And on that, often people think, well, withholding tax doesn't matter because I just claim it in my double taxation calc from the home country. Can you talk us through why that is often not the case?
Yeah, we wish it was so easy, don't we? And countries don't like giving that credit, I think, and they say, especially if they think, well, yeah, you're going to pay tax at 30% on a margin or whatever it is, say 5%, so that's what, 1.5. And meanwhile, you're going to try and claim a credit for 10%. Well, that can't be right. So they're going to restrict it. And that gets quite an interesting set of calculations. But the person who loses is generally the person trying to claim the credit. And that's the one. Secondly, their rules may be a bit more awkward. Thirdly, we see this occasionally. They'll say, well, you shouldn't have suffered this withholding tax. So why are you coming to us for a credit? You should have not paid it in the first place. It's like a voluntary contribution. Now, you may not feel like it's a voluntary contribution, especially if you weren't the one withholding from yourself. It's what inflicted upon you. But have you probably fought the issue with the other country or with your customer?
I think that's a very nice summary, Russell. And this is something that we often tell multinationals coming into Africa, that often withholding tax on services can be the single biggest cost impacting your business. So, firstly, withholding taxes on services are often extremely high, often 20%, and with no reduction under the DTA. Secondly, they're often levied in contravention of the double taxation agreement because the double taxation agreement doesn't allow it, which then can mean that your home country will not allow the double taxation relief because they'll argue it was levied in contravention of the double taxation agreement. So that can often mean that you're losing a 20% slice of your services fee, which you're obliged to charge from your home country because of transfer pricing rules. And when we're talking about services, I mean, a 20% margin is fairly substantial. So it can be a very large amount of money. And in our view, if it's not carefully modeled in the economic planning for the project, it can be a terrible surprise to catch later down the line.
Just comment on that, getting it. Yeah, it's bad enough on supplies and sales to outside parties where they take off this, but you could land up at a loss if you've got a 10% margin, you have a 20% withholding tax, it's a problem. But even on intercompany transactions, and you mentioned transfer pricing then, so a normal thing, let's have a cost plus, what, let's say 5 or 10%. Cost plus 10%, then a 20% withholding tax levied, the poor supplying company will have a guaranteed loss overall. And that's not really a sustainable position.
Yeah, no, it's really riddled with challenges. And can you talk us through grossing up? Because we have many clients who say, "Oh, I don't worry about withholding tax, I just gross it up." Can you explain to us why that doesn't work?
Well, it can work, but let's have a look at it. So this is really an attempt to say, well, I don't want to suffer this withholding tax. I think you, the customer, should suffer it. Let me shift the burden to you economically. Now, the first problem is a commercial one. He'd say, no, I'm not going to pay it. It's essentially a price increase, and I'll go somebody local or somebody else who'll be better. So that once you've overcome the commercial issue, you can then think what you're going to do with it. Well, one, have you put it in your contract? Secondly, making sure your invoice is right. So let me have a quick example. If I charge somebody 100 and I've got a 20% withholding tax. So grossing up does not mean I charge the person 120 overall, because that's not the grossing up. The grossing up takes you to 125. It's 100 divided by 80. 125 less than 25, which is 20% of 125, leaves you 100, which is what you expected. So we see quite often that arithmetical error comes up. And thirdly, that can have an effect not so much on services, but on goods. It can have an effect on your customs duties if you're grossing up. And finally, there's some unusual law, especially in Nigeria. Starting with the tax authority not liking this thing about grossing up withholding tax, saying that is really you're paying the supplier's tax, which isn't really true, but that's how they saw it. And when that argument got defeated, they changed the law. So now if you have a arrangement where you just transparently charge the withholding tax to the customer, he can't get a deduction, which makes his cost even higher because he can't
Wow.
get a deduction for it. So he'll say, no, I'm not having that, or you lose the customer. So then you need to try to make it a more opaque grossing up, which can be done, but it means you can't send an invoice fee plus
Showing the gross up.
gross up plus total. It has to be just a total, which means you've got
Wow, that's interesting. And another issue we've seen with grossing up, many suppliers who charge their third parties and then gross up the fee, they don't even bother then to claim the withholding tax in their home country. So they don't request the withholding tax certificate from the African country. And then that can often create more of a kind of culture of the revenue authorities not issuing withholding tax certificates. So when someone actually wants to claim them, it can be extremely hard to get the withholding tax certificate to try and claim the double taxation relief in your own country.
That can be hard anyway in certain countries. Again, I can think of Nigeria, where traditionally it's very hard to get withholding tax receipts for US dollar payments of tax. Largely, I think the payments going into a bank account in New York, and it was very hard to find the man who had got access to it to issue the receipts. That is supposed to be improving, but yes, it's a problem. And generally, there's also an emotional problem where your customer may think, well, blow me, I've already had to suffer an increased price to gross up. Now you're going to have a piece of paper which enables you to go and claim
Yeah.
something back again. That doesn't sound right to me. That's what they think. You then have to convince him, well, I'm not going to get any benefit from this.
Yeah.
There's one further little wrinkle rather. If you having a gross up, effectively you're increasing the price. Well, you are increasing the price, and your poor customer's probably going to have an increased reverse charge VAT on it, which may not be a problem if you can claim it back as input tax. But certain countries which don't like reverse charge input VAT and won't give input tax, I'm thinking of Rwanda and Uganda in particular, that is a further increasing cost.
So
Perhaps
I
all
think that,
designed to make imports of services unattractive and trying to boost the
yes.
economy or raise revenue, depending on how cynical you are.
Yeah. So I think the bottom line is beware withholding taxes in Africa, but really be very aware of withholding tax on services across Africa.
Yes, I think my opening position on it is assume there's withholding tax, find out how much it is, and if there isn't, you'll have a pleasant surprise.
Yeah, makes sense. So, guys, that's why we say withholding tax, particularly on services across Africa, can be your biggest single cost in operating across this continent.